Good morning, everyone. I know it's bright and early to be talking about taxes, but we're going to push our way through it, right? My name is Marcus Mims. I want to, first of all, thank you all for having me. I really appreciate you all wanting to get up early in the morning and talk about gross receipts tax and find out everything you always wanted to know about gross receipts tax. But I do really appreciate being able to talk to you about it, because I think it's really important to it's obviously really important to our state. In terms of what we'll talk about today, we'll talk about New Mexico's overall tax system. Just kind of give you a little bit of perspective a little bit. We'll talk a little bit more in depth about the gross receipts tax, and then we'll talk a little bit about what I think are some, in my practice, what I see are some of the more common pitfalls that I see clients make. Shameless plug, a little bit about our firm. I'm with Carr, Riggs & Ingram. We're a national firm. We're in 35 markets. We're a top 25 CPA firm. We have offices across New Mexico and primarily throughout the southern part of the United States. And we focus on audit, wealth advisory, and tax. And we specialize in all a number of different types of services and industries that we offer for our clients. If you want to connect with us, we're on all the social media. Overview of New Mexico's tax system. As I said before, I think any conversation about the gross receipts tax, I think it's important to kind of talk about how did we get here. And how we got here is, well, let me step back a little bit. New Mexico primarily relies on four major sources of income: gross receipts tax, the compensating tax, income taxes, which are both corporate and personal, and severance taxes. Together, these income sources represent over 70% of the revenue for the general fund. We also have property tax, but property tax is primarily a funder of the local government, so county and municipal governments. That's not a big revenue at the state level. And comparatively speaking, when you compare New Mexico's property tax to other states, relatively speaking, our property taxes aren't really that high, although you may look at your own property tax bill and say, well, I don't know what you're talking about. But relatively speaking, our property taxes aren't really that high. If you compare, particularly if you compare our property taxes to, say, our folks in Texas, or even in El Paso, our property taxes are extremely low. So how did we get here? Back during the Depression era, we created what was called the emergency school tax. And that particular tax applied to both goods and services. And it also included the mineral severance tax, or mineral severance. Sorry. It also included the mineral severance. New Mexico was unique back then because most sales taxes at that time, and still to this day, only applied sales taxes to the sale of tangible personal property. New Mexico was unique in the fact that the tax at that time applied to both sales of tangible personal property and services. And part of the logic in applying both services and tangible personal property was, well, New Mexico is an extremely small state. It's sparsely populated, and because of that, it needed a broad tax base. Okay, and so that hasn't changed as we have evolved into the gross receipts tax, but the gross receipts tax still taxes a broad range of tangible personal property and a broad range of services. Excuse me. Again, we remain one of the few states that tax services. Most sales taxes for across the country only tax the sale of tangible personal property and specifically enumerated services. Whereas New Mexico, Hawaii, South Dakota, and even West Virginia, those states tax a broad range of services. And because New Mexico does tax a broad range of transactions, the gross receipts tax is a relatively stable tax. And so, you can see, and I'll show a graph in terms of how the revenue has grown over time. But it is a very stable tax system, and it is a very stable tax structure. In fact, I think if other states had the ability to go back and revamp their tax structure, they would probably look to more of a gross receipts tax structure like New Mexico, rather than what they already have. So in 1959, there was a major rewrite of the emergency tax code, emergency school tax. In 1966, that Emergency Tax Act was replaced with the Gross Receipts Tax and Compensating Tax Act. In 1969, there was a major administrative reform that happened under then Commissioner Franklin Jones. And then in 1981 through 83, there was a Supreme Court decision that essentially said that taxes that are levied on the seller, because those taxes are levied on the seller, that means that the transactions can be taxable to the federal government, so that you can have taxable transactions with the federal government. And we'll talk about this in a little bit more detail. There is a federal preemption whereby states can't tax directly. States can't tax the federal government directly, but we know that there are transactions that happen that are taxable with the federal government, and because of that Supreme Court case, that sort of essentially solidified New Mexico's revenue base, and that allowed a lot more revenue to come in because of our heavy reliance on federal government activity here in New Mexico. So what's the difference between a gross receipts tax and a sales tax? I often say the gross receipts tax here in New Mexico is really our version of sales tax, but it really is a little different than what you see, than sales taxes in other states. And the major difference in a sales tax and our gross receipts tax is that our gross receipts tax, the legal responsibility for the gross receipts tax is on the seller. Okay, so The seller can, the seller, whether the seller passes on the tax to the buyer does not matter. If the seller does not pass the tax on to the buyer, then the seller is still responsible for the gross receipts tax. Whereas in a true sales tax, the seller acts as a collector of the tax from the buyer. And the buyer, the sales tax is really legally imposed on the buyer. But the seller is really acting as a collection agent for the state in collecting that tax from the buyer. Okay? So that's really the main difference. It's really who's legally responsible for the tax. When we go to, let's say we go to Walmart, and you get your receipt, it says gross receipts tax or it says sales tax. Whether I go to Walmart in Texas or whether I go to Walmart in New Mexico, that receipt looks exactly the same. The rates are different, but it looks exactly the same. However, the difference is that in Texas, Walmart's acting as a collection agent on behalf of the state of Texas. Whereas in New Mexico, Walmart is legally imposed, the tax is legally imposed on Walmart, but Walmart is passing that tax on to me as the buyer. We already talked about this case. That essentially upheld New Mexico's right to tax transactions with the federal government. And so because of that, New Mexico was able to protect a lot of the federal government activity, and I won't say protect, but enable to tax a lot of the activity with the federal government. So as you might imagine, the gross receipts tax is the single largest revenue producer for the state of New Mexico. It funds education, infrastructure, and government distributions. This is primarily where a lot of the local governments get their money. And as I said before, it's a really stable tax. Sales taxes are a little bit less stable. New Mexico's gross receipts tax is a lot more stable because of the fact that we tax a broad range of transactions. When the gross receipts tax was initially implemented, the idea was that you would have this tax on a broad range of services, but you would have this very, very low rate. And so I think when the gross receipts tax was initially implemented, I think the rate was like 2%. That has gone out the window. So, we're at 7, 8, 9% in some cases, which really kind of defeats the purpose of having a gross receipts tax when your rate is that high. We're getting into rates where we're less competitive with other states, because our rates are just as high as relative to some of our states or surrounding states. So when you talk to tax policy experts, the idea is that, the ideal is that you would want to have a tax revenue system that equally relies on multiple types of tax sources. So if you have property taxes, you have sales taxes or gross receipts taxes and income taxes, you would have a sort of an equal reliance on all of those revenue sources. We don't have that here in New Mexico. We have really an over-reliance on the gross receipts tax and the severance tax. At some point, the severance taxes, we're not going to have that anymore. I'm not sure when. People keep predicting that it's going to come to an end. I don't know when it's going to come to an end, but New Mexico is highly reliant on the gross receipts tax, which means that, yes.
I'm sorry, what's a severance tax?
The severance tax is a tax on oil and gas activity.
Thank you.
Yeah, sorry about that. And please, if a question comes up, please let me know. Yes, ma'am.
Now that you said that, when you went back to the Walmart idea that they
Yeah,
can pass
yeah,
it on,
yeah.
can they choose to pass on a percentage, or does it have to be the entire thing? Like, can a business choose to, in that?
They can pass on whatever they want.
Yeah.
However, that doesn't necessarily make sense for them.
Right.
Just from a compliance perspective, it wouldn't make sense for them just because it's much more complicated to kind of figure that out. And now, and I'll talk about this a little bit more when we start kind of getting into sort of the nuts and bolts of the gross receipts tax and the compensating tax. But there's sort of two complementing taxes. There's the gross receipts tax and the compensating tax. The gross receipts tax is a tax on the seller, okay? So I'm a seller, I'm a merchant, I sell things, I'm subject to the gross receipts tax. The compensating tax is sort of a companion tax. It's a use tax. Every state that has a sales tax has a use tax. And the idea behind a use tax is that if I go to a local merchant, they're going to charge me tax. So to keep me from going to making a decision by purchasing from out of state where they are not necessarily going to charge me tax, I'm subject to the compensating tax as a buyer or the use tax. And we'll talk a little bit more about how that works. So my point being is that if a merchant doesn't charge me tax or doesn't charge me all of the tax, I may still have to pay the tax as a buyer in the form of use tax. So as a buyer, I'm not really being helped by that. And then on the seller side, it's a lot more complicated. And probably I'm reducing my margins because I'm not collecting all the tax that I should have.
Thank you.
Well, okay, there we go. So we talked a little bit about this. I talked a little bit more. Benefits of the gross receipts tax, it's broad and it's stable. The issues is that it's regressive. And when we say regressive, what we mean is that folks at the lower income structure are paying more of their income in taxes than folks at the higher income. And so most gross receipts taxes or sales taxes, they're going to be regressive taxes. Any type of tax reform, excuse me, should strike the balance of over-reliance on the gross receipts tax. Again, New Mexico's really heavily reliant on severance taxes and gross receipts taxes, which means that you really can't have meaningful reform because of New Mexico's over-reliance on that particular tax. So if you wanted to really kind of shape policy or do anything that was groundbreaking, it really is difficult to do because of the fact that New Mexico over-relies on the gross receipts tax. And you know, when you try to cut here, the question's going to be asked, okay, where are you going to find where are you going to find that money? So let's dig into the nuts and bolts of the gross receipts tax.
One question.
Yes,
Why
ma'am.
is this severance tax going to go away?
Because ultimately, the idea is that the severance tax is based on the fact that you have all of this oil activity in the Permian Basin, and it's built on the idea that at some point, all of that oil is going to be extracted, or at some point we're not going to be able to extract anymore.
Okay.
And so those resources, the idea is those resources are going to go away. That hasn't happened yet, and we still keep finding, areas where there's more and more. So,
Thank you.
yeah. Oops. I talked before, the gross receipts tax is a legal responsibility of the seller, as opposed to in other states where the seller has a collection responsibility. Okay, so it applies to all goods and the sale of all goods and services, and the rate that I pay on the gross receipts tax is based on generally speaking, is based on where my customer is located. So that changed 5 or 6 years ago. It used to be based on where my office was located. Now it's based on, which is much more complex, based on where my customer is located. So you can imagine if I have a business where I'm shipping product all over the state, I'm responsible for determining where my customers are located and charging the gross receipts tax at that rate. So what does engaging in business mean? The definition is carrying on or causing to be carried on any activity with the purpose of direct or indirect benefit. So performing any activity for gain or benefit. So implicit in that definition is that I don't have to receive money. I can receive any kind of consideration, any bartering, any kind of consideration can be subject to the gross receipts tax. It also means if I have a physical presence here in New Mexico, if I have offices here in New Mexico, if I have employees, if I have property, I'm subject to the gross receipts tax on any transactions that I incur here in New Mexico. Well, what if I don't have offices? What if I don't have any presence in New Mexico? What if I'm just selling into New Mexico? Well, if I sell more than make more than $100,000 of sales, even though I have no physical presence in New Mexico, I'm still required to collect or pay gross receipts tax on my transactions in New Mexico.
Can I ask a question on
Yeah,
that?
absolutely.
So for, companies like eBay, Etsy, Amazon, where there's sellers, part of an umbrella, how does that work out?
Great question. So, this particular rule was created for the Amazons and eBays of the world. In 2018, there was a Supreme Court ruling called Wayfair versus South Dakota. Prior to that Supreme Court ruling, in order for a state to require a seller to collect sales tax, that seller had to have some kind of physical presence in the state. Okay, so before Wayfair, before 2018, if I'm an Amazon, if I'm an eBay, I don't have any bricks and mortar. I don't have any payroll. I'm just selling my product into a state. I wasn't collecting sales tax. And so the states were like, we're losing all that money all these big companies, they're selling their products into our state, and we're not collecting any tax on those transactions. And so the states became really aggressive, created these different rules. States attacked it differently, and tried to pull in the Amazons of the world into their respective states. Well, this particular case, South Dakota versus Wayfair, sort of worked its way up through the system, and South Dakota essentially said, "Hey, look, you have a certain level of economic activity in our state, and so we no longer think physical presence is required in order for us to require you to collect sales tax. We're gonna set a $100,000 threshold and say if you meet that $100,000 threshold, you're required to collect sales tax." Well, obviously Wayfair balked, and in that case made it up to the Supreme Court. And you got to remember, when the physical presence test was sort of blessed by, was sort of blessed, we were talking about like in the 60s, when there wasn't an sort of online presence, when there wasn't the internet, when you'd go into the store, physically go into the store and purchase your goods. Well, in the Supreme Court case, the Supreme Court recognized that, that requirement was no longer realistic. And the Supreme Court essentially said that, no, we agree, you don't have to have physical presence in order for a state to compel you to file sales tax returns. It's enough that you have an economic presence. And states can figure out what that economic presence is on their own, and states have. So most states now have some sort of economic level threshold. And so most states have said, if you make $100,000, if you sell $100,000 of sales in our state, even though you have no other connection, you still have to collect sales tax. Some states are at $250, a handful of states are at $500. And I'm going to answer your question. So you have that. So Amazons and eBays and all of those, they now have to collect. And so that doesn't just apply to Amazon, that applies to any kind of online retailer. But then you have this area where, I'm just a small business, and I want to use Amazon's marketplace and sell my wares. Well, most states, along with this rule, have some sort of what they call Marketplace Provider Act. And what they're saying is that if you are a marketplace seller or a marketplace provider, like Amazon or eBay, and you allow sellers to use your platform to sell their product, well then, we're going to require you to collect sales tax on those folks' behalf. And then we're going to make you collect sales tax. And so, like Amazon has a marketplace platform where folks can, utilize their marketplace services, sell their product. In that case, Amazon, if I sell something on Amazon, Amazon would collect the sales tax on my behalf because that's what they're required to do. And every state that has a sales tax has some sort of marketplace provision that says the Amazons of the world, if they're providing a platform to allow folks to sell on their platform, they have to collect sales tax on behalf of those folks. And so the complicated piece of it is that, let's say for example, I'm in New Mexico, I am subject to the gross receipts tax, so I'm paying gross receipts tax, but I also am selling on Amazon. And so I have to keep track of my sales that I make directly to my customers, but then I have to know that Amazon is making sales on my behalf too. And Amazon is collecting sales tax on my behalf. So I have to know as a seller, sales that are being tracked through Amazon, sales that are being tracked directly. That's my responsibility as a seller. Did that answer your question? Yes, sir.
Marcus, is that 100K annualized, or is that just like a?
It's an annual,
Cumulative or-
yeah, it's on an annual basis.
Okay.
Yeah. So what are gross receipts? Gross receipts are the total amount of money from selling property in New Mexico, leasing property in New Mexico, the right to use a franchise in New Mexico, selling services in New Mexico, selling services performed outside of New Mexico, the product of which is initially used in New Mexico, and yeah, selling services outside of New Mexico, the product of which is initially used in New Mexico. So that's a lot. Most states, when you were talking about sales tax, their definition is selling property in New Mexico, leasing property in New Mexico, and maybe specifically enumerated services, maybe 8 to 10 different services. Okay, so we're taxing a broad range of services that other states do not tax. The presumption is if you're doing business in New Mexico, your receipts are either taxable, exempt, or deductible. Okay? Exemptions. Exemptions are receipts, are non-taxable receipts that don't have to be reported on your gross receipts tax returns. So, if the only thing that I have in terms of my receipts are exempted receipts, I don't have to be registered or report gross receipts tax. Some of the more common exemptions in New Mexico, well, there's a federal preemption for transactions with tribes. So if I am working or providing product or services to an Indian tribe or Pueblo, and that transaction takes place on that tribe's land, that I'm preempted from the state is preempted from taxing that transaction. Okay. Now, if that transaction doesn't happen on that tribe's land or off of tribal land, that's going to be subject to gross receipts tax. What's preempted is providing services or selling product to that tribe on their land. Yes.
So how about a tribal member, I guess, or a person of
So-
the tribe?
Yes. As long as it's an enrolled member of that particular tribe.
So how do we determine that they are, number one, if they're my customer? Do I ask them, are you a tribal member? Number two, why is our tribes listed on the locations when we submit those receipts taxes?
Because you could have, theoretically, you can have transactions on tribal land that are with non-tribal members.
Okay.
Yeah, yeah.
So I have to ask them. Point blank,
Absolutely.
Are you a tribal member? Do I
And-
ask for proof or just
Well,
take your word
yes,
for it?
yes, like for example, you have transactions with tribal members.
Right.
The proof that they're a tribal member is they have an enrollment number, and they provide you with their enrollment number.
Okay.
That's pretty well known.
So I can ask for that?
Yeah.
Thank you.
And so as an example to your question, let's say for example, I'm a construction contractor, and I'm doing road construction on tribal land, but my customer is the Bureau of Indian Affairs. That's subject to gross receipts tax. Receipts of a 501c3 organization are exempt, except if I'm a prime contractor of a national lab. Or if I'm a hospital licensed by the Department of Health. So these are fairly recent exceptions. I think it was 2020 when this one came through. So when the most recent contractor at the labs took over, and there was talk about the fact that they were going to be a 501c3, that law changed. And in conjunction with that law, they included the hospitals. Yes?
Marcus, what is UBI?
UBI is unrelated business income. So if a 501c3 is engaging in transactions in pursuit of their mission, that's exempt from gross receipts tax. But any transactions that are outside of their primary mission, which is called unrelated business income.
So that'd be like a church with a food truck on their property, for instance?
Yeah, that would be, I don't know that I could give you a specific example, but it would be something that is outside of their primary mission. And so assuming it's outside of their primary mission, that's subject to gross receipts tax.
Sorry,
So
can I-
what if they sell stuff? They sell glassware, they sell t-shirts.
Plenty of 501c3s sell stuff. It's not subject to gross receipts tax. The differentiator is, again, because each 501c3 is different and their mission is different. To the extent that it's outside of their mission, primary mission, that is going to be subject to gross receipts tax. Just because they sell stuff in and of itself is not necessarily going to be subject to gross receipts tax. The fact is, are they doing it in pursuit of their mission, or is it something that's outside? And that generally is a facts and circumstances kind of analysis. Great questions.
Actually, I got one more. Sorry.
Yes.
So between points 2 and 3, so if I've got an electrician who's doing work down in Kirtland,
Yeah.
and so he's exempt under the federal government piece, right? Because the DOD or the government would be his customer, his business payer?
No, let me clarify that. So New Mexico can't tax transactions. New Mexico can't tax the federal government directly.
Right.
New Mexico can tax transactions with the federal government.
Thank you. Okay.
Yeah. So, interest and dividends, they're considered an exemption. If I have an isolated and occasional sale, okay, so let's say, for example, I do a garage sale. Well, technically, I'm engaging in business, but New Mexico would consider that an isolated and occasional sale. Now, if I have a garage sale every week, now I'm in business. Okay? So it's going to be, New Mexico's going to look at, okay, and every state most states that have sales tax have these kinds of exemptions. has an isolated and occasional sale exemption, I should clarify. But New Mexico is going to look at what are you selling, how often are you doing it, and they're going to look at so consistency. So if I'm doing this once every year, every couple of years, maybe even twice, that's probably going to be an isolated and occasional sale. But if I'm doing this consistently, even though I'm not doing it every single day or every single month, then I'm running in the risk that it's not an isolated and occasional sale. So again, you have people that sell at these like festivals or sell at farmers markets or something or stuff like that. If I do it once, that's an isolated and occasional sale. But if I'm doing it ongoing, I'm in business, and a lot of people don't realize. They don't think they're in business, but they don't realize that they really are from a gross receipts tax standpoint. Deductions. So deductions are non-taxable receipts that do have to be reported on your gross receipts tax return. Okay. We call them deductions, but we don't want to confuse that with general expenses deductions, because we can't take general deductions for general expenses on our gross receipts tax returns. In order to, you have two different kinds of deductions. One's our statutory, the other is deductions that need to be supported with some kind of documentation. And this kind of gets to the point where you were talking about, where you were asking. Sometimes if I'm taking a deduction, I have to have some kind of proof. Now, there may be transactions where the very nature of the transaction is deductible. But then there may be transactions, and we'll talk about this, maybe transactions where I need to have some kind of documentation to support that deduction. And the typical documentation is what we call a non-taxable transaction certificate, or an NTTC. Other states call them resale certificates or exemption certificates. For farmers and ranchers, we have a farmers and rancher statements. We have multi-jurisdictional uniform sales and use tax certificates that work nationwide. If you're in solar transactions, you have solar energy deductions, written statements, and then the state does allow for alternative evidence. If I don't have an NTTC, I can take a statement from my buyer saying that, hey, they're reselling it and they're using it in the ordinary course of business, and that should work. So again, this kind of goes to what I was just talking about. The non-taxable transaction certificate, that's the most common way of supporting some of my deductions. And most common deductions used by non-taxable transaction certificate are sales of tangible personal property or services for resale, construction, sales of tangible personal property to the state government, sales of tangible personal property to the federal government, sales of tangible personal property to a 501c3. Common deductions: sale for resale, services, tangible personal property, sales of tangible personal property to the government. So if I'm selling tangible personal property to the government, whether it's federal or state, that's deductible from gross receipts. But if I'm performing services, that's taxable for gross receipts tax purposes. The issue sometimes is, what if I'm doing both? And what if it's a bundled transaction? That starts to get pretty complex. Subcontracted labor for a construction project, that's when I'm able to use an NTTC. Tangible personal property to a 501c3 organization. Rent or sale of real property is deductible. Transactions in interstate commerce is deductible. Manufacturing inputs are deductible. Sale at food, a grocery store, food is not subject to gross receipts tax anymore. Sale of prescription drugs are not subject to gross receipts tax. So that's an example of, that's a statutory deduction. I don't need an exemption certificate or a deduct, or an NTTC. That's already in statute. I just have to show that it's a prescription drug or it's a food. Yes, sir.
So sale of food in other venues, so like you're selling food at like a convenience store, that is taxable?
Yeah, so it has to be at a grocery store. It has to be it has to be certain establishments that are where it makes it taxable, or where it makes it deductible. It can't just be any establishment. Gross receipts tax rate. We determine the gross receipts tax rate. The seller determines the gross receipts tax rate based on their buyer's location, for the most part. There are exceptions to that, but for the most part, it's based on where your buyer is located. Rates can change twice a year.
We changed that law. It can only be once a year now. And the only time you can do it January 1st is if it's an emergency declared in your county.
Oh,
So
that's
new
right, that's right.
legislation,
That-
just heads up.
Yeah, I appreciate that, yeah. I did see that. Again, gross receipts tax are based on where it's delivered. And I think, that's not the updated rate, right? The rate just changed, right? Okay, yeah,
That's the current rate though.
yeah, okay.
That's not our rate.
No, it's 7.68, isn't it?
It will be 7.6875.
Yeah, that's what,
Next year,
In
yeah.
July.
It's gonna go up
prior
though,
to
right?
the states taking their
Right, right.
year marking.
Was that,
So-
when is that? Is that January 1st?
1st of 2026.
Oh, okay. So you can see how much revenue we're taking in from the gross receipts tax. About a little over $4 billion of revenue that we're taking in. In terms of which industries make up the gross receipts tax, services and retail are 50% of the revenue that we get from gross receipts tax. Construction is about 50%, 15%. A little bit about a compensating tax. Compensating tax is the complement to gross receipts tax. So if the seller doesn't charge me gross receipts tax, as the buyer, I'm responsible for paying compensating tax. Every state that has a sales tax has a complementing use tax. And so as a buyer, now as an individual in New Mexico, I'm not subject to I'm not subject to compensating tax. But if I'm a business, I am subject to compensating tax. So I can't go out and, if I'm in Las Cruces, rather than purchasing furniture at the local store, I can't go to El Paso or order it from El Paso and have it shipped to me and then them not charge me tax. I'm responsible for paying New Mexico compensating tax if they don't charge me either Texas sales tax or New Mexico gross receipts tax. If they don't charge me New Mexico gross receipts tax, but they charge me, if an out-of-state seller charges me their own state's sales tax, then I can take a credit for the tax, on the compensating tax, for the tax that I paid to that other state. So some of the more common pitfalls that I see: not realizing that your activity is scheduled is subject to gross receipts tax. So the Taxation and Revenue Department does a lot of what we call Schedule C tape matches, okay? And so a lot of businesses will come in here, a lot of companies will come in here, individuals, and they don't realize, number one, that New Mexico taxes services or professional services. A lot of folks who receive Schedule C income, 1099 income, they don't realize that that income can be subject to gross receipts tax. What New Mexico does is that New Mexico will take your Schedule C, if you're a resident, New Mexico will take your Schedule C that you filed with the IRS, match it to and try to determine whether you paid gross receipts tax or not. And if they can't find a corresponding gross receipts tax number for that Social Security number or EIN number, then they will send you a little nice letter saying, we think you should have paid gross receipts tax, and here's the amount we think you should pay. If you disagree with us, please call us and let us know. Otherwise, by this date, we're going to assess this much tax. And that happens to a lot of folks. Inaccurate record keeping, failure to report compensating tax, failure to maintain the proper support for your deductions, misapplying rates or exemptions, late filing penalties, late filings and late penalties. New Mexico does have a managed audit program, so if you find yourself in a situation where, hey, look, I didn't pay gross receipts tax, or I should have paid, I'm late, or something like that, New Mexico has a managed audit program that allows you to bring your liabilities forward. The benefit to that program is that it's almost like a self-audit, and you can acknowledge your liability, and you don't have to pay penalty and interest, and you have 180 days to pay the liability. So it's a pretty good program. It's actually pretty beneficial. Clients utilize that program all the time, and in a lot of states that have similar programs, either a voluntary disclosure or a managed audit, a lot of those states will only abate penalty. They don't necessarily abate interest, and so New Mexico's program is that particular program is pretty generous. So I kind of went through the last part real fast because I knew I was running out of time, but hopefully, I don't know if there's any questions, but I hope I was able to give you some good information. Any questions?
I do have a unique question that's
Sure.
unique to Los Alamos. But let's say I'm one of the prime laboratories that's not exempt, but I contracted for a warehouse on tribal land where all of my supply purchases go. So all the destination-based delivery goes to a tribal operation. Is that subject to tax? And it's probably from the Amazons and all of the out-of-state vendors where I purchase most of my supplies. Would that, because it's on tribal land, not be subject to tax?
So you purchased product and you're storing it on tribal land?
Yeah, let's say I'm the lab and I'm doing that.
Okay.
And I have a huge contract to store all my supplies on a tribal land. And then I use that service to come truck it up to the location of Los Alamos. That's its final destination, but where it gets sorted and received is on tribal land. So that's an interesting question we've tried to figure out. Where does the tax go?
Oh, so where does the tax go, not necessarily whether it's taxable or not?
Well, either one, yeah. Is the final destination in this county because that's where it's delivered, or is it not subject to tax because it gets received on tribal land?
I would say, based on what you're telling me, I would say when the transaction ends is where the final destination is.
That's what I think as well, but we're just, we're not
Yeah,
sure.
that's what I would say.
Yeah.
And then whether it's taxable or not, it depends on who's the parties to the transaction. So if a tribe is not party to the transaction, it's not happening on tribal land, then the fact that it's tribal land is only relevant to the rate, in my opinion. So it's really, to me, about two taxable entities that are engaging in transactions. that happen to be on tribal land. Assuming I'm hearing your question
Yeah.
correctly.
Yeah.
Any other? Yes, sir.
Oh, I had a quick one, as far as the clarification goes. The chart showed that it was 15% on construction.
Yeah.
But I thought the previous slides were saying, and maybe that's just the prime contractor, but if a construction contractor subs a bunch of services out, right, like maybe the excavation, the pouring, the subcontractor is not subject to the gross receipts?
Correct.
But then the prime would? So
Correct.
would that roll up?
Yeah,
Let's say he
so
subs 300,000.
So the way construction works here in New Mexico is that if I'm the prime or the general contractor, I'm the one that's paying the gross receipts tax on the construction of the entire
Okay, the
project.
entire thing, okay,
Yeah.
that's what I was, okay,
Yeah,
clarify.
so I buy my materials tax-free, I purchase my subcontracted labor tax-free, all down the chain. There's no tax at any point for subcontracted labor and materials. But then when I turn around and sell to the project owner, or the landowner, building owner, that entire project is subject to
Gotcha,
gross
okay,
receipts
so
tax.
it's everything that rolls up essentially anyway, okay.
That's different, that's handled differently than the way other states handle it.
So if you're a subcontractor, then you would have a deduction, right?
You would have a deduction, and you would ask the prime contractor for an NTTC. Yep. Yes, ma'am.
So I find that locations are quite cumbersome and difficult to identify.
Absolutely.
Is there a map in?
Have you used,
system?
have you used the department's tool? Have you been able to?
GIS map on the tax return website
Okay.
that can pinpoint exactly.
Yeah.
So the GIS map locator.
Yeah, the department has a tool that, try it and see if it's not wonky or anything, but they tout it quite a bit, so,
Try again.
yeah.
Thank you.
Thank you, everyone. I appreciate it.